It is not sufficient to just choose the finest stocks to invest in, even if you have extensive expertise investing in the stock market. You ought to additionally have the ability to construct a portfolio consisting of a number of different stocks in order to maximize returns while simultaneously minimizing losses. Diversifying your holdings is essential if you want to cut down on investment losses while maintaining the same level of return on your money. It is a question that's been puzzling investors for centuries. How many different equities do you need to have in your portfolio in order to accomplish this? Because Warren Buffett is so knowledgeable in this area, we'll be looking into these experiences and advice. However, he believes that this is an area where the majority of investors err. Therefore, it is important to pay attention. Diversification in its current form and as it is being carried out makes investors more aware of what they are doing. Welcome to Smart Stock Academy, where you'll discover videos about businesses and insights from your prominent CEOs. Thank you for joining us for today's video, and let's explore topics that will awaken your curiosity when it comes to stocks and investments. Make sure to like, share, subscribe, and click that notification bell to assure you that you'll be updated whenever we upload videos. To begin, let's examine the number of stocks that Warren Buffett had in his portfolio when he first started his career as an investor, and then contrast it to the number of stocks that he currently has. When Warren Buffett was only 11 years old, he made his first investment in the stock market in 1941. He paid the amount of $114.75 to acquire 3 preferred stocks of a corporation that goes by the name City Service. Since his total net worth that time was $120, he pretty much put everything on the line. There is not much of a diverse selection to discuss, but a few years later, when Buffett was already 19, he had a change of heart about a few things. During this time, he studied The Intelligent Investor. Subsequently, he attended Columbia Business School to study value investing with Benjamin Graham. Graham was the manager of an investment partnership known as Graham-Newman. In 1951, this partnership held more than 100 diverse holdings in his portfolio, despite the fact that it was heavily weighted toward a few select holdings. Buffett reasoned that maybe a single stock is too little, and as a result, he expanded his portfolio to include 7 other companies, and he came to the conclusion, quite similar to Graham's, that he should invest more. By the time January 1962 rolled around, Warren Buffett had recently amassed $1 million in wealth thanks to his own investing partnership, Buffett Partnership Ltd. Few details have been released about the partnership's financial situation. However, Warren Buffett has given a few hints about his portfolio allocations in 1962. Quote, "We usually have fairly large positions, 5% to 10% of total assets, in which of 5 or 6 generals, one type of investments in the partnership, with smaller positions in another 10 or 15. End of quote. Also, Buffett said in 1966, quote, "We probably have had only 5 or 6 situations in the 9-year history of the partnership where we have exceeded 25%. End of quote. According to the statement released by that time, Buffett also stated, quote, "We presently have 2 situations in the over 25% category. One a controlled company and the other a large company, where we will never take an active part." In light of this, it seems likely that Buffett was a proponent of concentrating his efforts on a single endeavor at a time. More than 40 publicly traded firms and greater than 50 total owned and operated subsidiaries are among Warren Buffett's holdings. However, despite the fact that the majority of these corporations are not publicly traded, we are going to proceed with our attempt to describe the contents of his present investment portfolio. The present composition of Warren Buffett's portfolio appears to be as shown here, according to our research. Still extremely top-heavy, but not nearly as focused on a few corporations as he used to be in the earlier days. Does this imply that Buffett believes that a portfolio consisting of 100 companies is preferable to a portfolio consisting of 10 companies in today's market? Since he is more smarter and mature, he finds that it is not in his best interest to focus his portfolio. Working with the amount of revenue that Berkshire does allow them to do things that we'll never have the opportunity to do. We make an effort to pack as much as we can. Even while we will occasionally have the opportunity to participate in marketplaces, it is quite rare that we will be able to purchase as much of any worthwhile concept as we want to. Therefore, the answer is not that Buffett would prefer not to manage a concentrated portfolio now. It's only that when he narrows his focus to the elephants of the corporate world, he almost never comes across a situation in which one of those elephants is both comprehensible and overlooked. Now that we have that out of the way, let's talk about the 4 rules of thumb that Warren Buffett used to figure out how many stocks or how few stocks you must have in your investments. Also, the same line of reasoning may be applied to other kinds of assets as well, such as property investments of bonds. Now you need to think about the following. First, are you a know-something person who invests? Diversification can serve as a shield against the danger of ignorance. If you want to ensure that nothing negative occurs to you in comparison to the industry, you need to be certain that you obtain everything. There is no problem with doing that at all. That is a strategy that is reasonably valid for someone who does not feel as if they know how to examine businesses. If you have the ability to evaluate businesses and assess their worth, it would be insane for you to hold 50 shares, 40 shares, or even 30 shares most likely. Customers of brokerage firms have a legal obligation to be informed that your capital is at stake. There is not a single stock market firm that can be considered as a sure bet, and it is entirely conceivable to sustain a string of losses. When it comes to investment, a knowledgeable investor is aware of what to commit to, or at the very least has a general sense of possible outcomes and knows the scopes before committing to an investment. The know-something investor has carried out activities such as the following. Read through the accounting records of the firms in which he invests, carried out research on the managers and shareholders of the companies in which he invests, had an understanding of who the most significant rivals in the industries he operates in, evaluated the cost of his investments in relation to other potential changes in the stock market. When you have more information about specific businesses, you will require less diversification in your portfolio. And on the other hand, if you don't know these characteristics about firms, it is best that you invest in a wide variety of assets, most likely through an index fund, because you honestly do not know what sort of industry you are engaging in. Take into account the fact that this varies from nation to nation as well as industry to industry. Because this kind of introspection is incredibly hard to do. A reasonable proxy as to how much you understand is the amount of time you spend exploring companies per week. People who do not have a lot of time to devote to researching individual stocks and bonds might look into index funds. In 1993, Warren Buffett made the following observation about investing. By periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. It is important to know the limitations once you invest. Second, do you have any investment in high-risk assets? Even at the gaming tables in which the casino has an edge that can be calculated scientifically, players should still diversify their bets. Because of this, there is a cap placed on the total amount that can be wagered at that establishment. Casinos are aware that a losing streak might result in bankruptcy, and that earlier outstanding profits cannot compensate for that loss if it occurs. The higher the risks associated with the wagers that you are placing, the greater the importance of diversification becomes. Risk is something that pertains to a number of different possibilities with us. One of the possibility of suffering a loss of capital that is irreversible. And then there is also the possibility of getting an unsatisfactory return on the type of capital that we invest. It is absolutely nothing to do with the degree of volatility. It should come as no surprise that the stock market cannot be quantified to the same extent as the casino. In terms of riskiness, the things you need to keep an eye out are securities in which, if you are incorrect, you are prone to losing everything that you have invested in that holding. The following are some examples of such circumstances. Companies filing for bankruptcy, industries that are undergoing a great deal of change, almost everything that involves the use of leverage. You should also keep an eye out for any relationships that exist between the holdings you have. Third, there are any opportunities that are significantly more advantageous than others. If you are a know-something investor, you should be able to evaluate the potential profitability of particular chances, perhaps not everywhere, but at the very least within the scope of your existing knowledge and experience. Take for instance the scenario in which you have located businesses that you believe have a good chance of returning the following. In light of the aforementioned circumstances, it makes perfect sense to include this business on your top lists. You will be diversifying your portfolio if you invest an equal amount of money in companies numbered 6 through 10, because doing so will result in lower predicted returns. This is a word that was taken from Peter Lynch. In addition, you should focus the majority of your resources in developing that one idea that has the most potential. In a similar manner to what Buffett has done recently with Apple and BNSF, as well as what he performed around 1951 with Gecko. Lastly, is there a way to earn it over? You will come across situations in which it would be an error to operate with fewer funds. For example, it would be an error to invest less than half of your wealth in the business. The amount of money you have to invest is directly correlated to the number of stocks you should hold. This is the fourth rule of thumb. It is dependent upon where you're at your investment profession as well as the amount of money you receive. For instance, if ever you only have 1 month's worth of salary available to invest, you might possibly go bet it all in a single investment. We wouldn't be shocked if you said you'd bet it all at a local casino, which is also a terrible idea. But at least you can get it back the following month. When we start talking about quantities of money that it will take you a few years to make back through your regular work, though, you really need to start thinking about diversifying your investments. One of the most severe examples would be if you have just recently acquired a significant quantity of money all at once. You really need to narrow your investment focus if any of the following apply to you. A know-something investor who purchases assets that are associated with a low probability of unfavorable outcomes, anticipating a big disparity in rates of return between the many chances you've uncovered. Being able to make up for losses in money pretty rapidly through earnings. An investor will have a massive influence if he is conscious of the direction his cognitive process is taking at any given time. That's it for today's video. Let us know what you think and leave it in the comments section so we'll know what your insights are. Again, make sure to like, share, subscribe, and click the notification bell for more updated videos about the business world.